Have you ever wondered how traders predict market moves and maximize their profits? In today's video, we'll dive deep into one of the most powerful tools in the world of stock trading, future and option chain. If you're a beginner or an intermediate trader, this video will help you understand how these concepts work, how to read the data, and how to use it for your advantage. Introduction. Welcome back to the channel. In today's video, we're going to demystify the concepts of futures and options and how to interpret the option chain data to make more informed trading decisions. Whether you're new to trading or looking to enhance your skills, this guide will give you a solid foundation. We'll cover what futures and options are, how to read and understand the option chain, how futures and options are traded, practical strategies to use futures and options, real-life examples and case studies, too. What are futures and options? Futures contracts. A future contract is a legal agreement to buy or sell an underlying asset at a predetermined price at a specified time in the future. It's a derivative product that derives its value from the asset it represents, like stocks, commodities, or currencies. Key features: standardized contracts. Futures contracts are traded on exchanges and are standardized in terms of quantity, quality, and delivery dates. Leverage. Futures allow traders to take large positions with a smaller initial margin. Settlement. The contract is either settled by physical delivery or cash settlement, depending on the terms. Types of futures contracts. Commodity futures. For products like gold, oil, etc. Financial futures, based on stock indices, currencies, etc. Options contracts. An options contract gives the holder the right but not the obligation to buy or sell an asset at a specific price before a certain date. There are two main types of options: call options, the right to buy; put options, the right to sell. Important terms in options trading: strike price, the price at which the underlying asset can be bought or sold; expiration date, the date on which the option expires; premium, the price paid for the option contract. In the money, when the option has intrinsic value, for example, for a call option, the market price is higher than the strike price. Out of the money, when the option has no intrinsic value. Example: let's consider an example of buying a call option on stock XYZ with a strike price of 100. If XYZ's stock price rises above 100 before the expiration, you can exercise your option to buy at 100, making a profit. 3. Understanding option chain. What is an option chain? An option chain displays all available options contracts for a particular security like a stock or index, showing the various strike prices and expiry dates. It's a vital tool for traders to determine market sentiment, volatility, and the potential movement of the underlying asset. Key columns in an option chain: strike price, the price at which the asset can be bought or sold; open interest OI, the total number of open contracts, both calls and puts; volume, the number of contracts traded during the day; bid price, the price buyers are willing to pay for the option; ask price, the price sellers are asking for the option; implied volatility IV, a measure of expected volatility in the underlying asset; delta, gamma, theta, vega, these are known as the Greeks, which measure the sensitivity of the option's price to various factors like time decay and price changes. How to read the option chain. Here's a breakdown of how to interpret the option chain data effectively. Calls versus puts. The left side of the chain typically shows call options, and the right side shows put options. Open interest OI analysis. Higher open interest indicates greater liquidity and interest in that particular strike price. Volume. An increase in volume shows higher trading activity and potential market movement. Implied volatility IV. Higher 4 often means higher option premiums. Understanding the 4 can help in assessing potential market movement. Example: suppose you are analyzing the option chain for Nifty 50. You notice a lot of call options at 18,000 strike price, with high open interest and volume. This could indicate that traders are expecting the Nifty to go above 18,000 soon. Reading sentiment from the option chain. Option chains can provide valuable insights into market sentiment. Bullish sentiment. If more call options are being traded and open interest is rising, it suggests a bullish outlook. Bearish sentiment. If more put options are being traded, it may indicate bearish sentiment. Neutral sentiment. If both calls and puts are trading with high open interest, the market may be expecting low volatility. 4. Futures versus options. Obligation versus right. Futures contracts require the trader to fulfill the contract at expiry, whereas options give the right to buy or sell without the obligation. Risk and reward. Futures are riskier since both parties are bound by the contract. Options offer limited risk to the buyer, the premium paid. Leverage. Both futures and options provide leverage, but futures involve a higher level of commitment, whereas options allow for more flexibility. Settlement. Futures typically involve physical delivery or cash settlement. Options usually don't require physical delivery if the option isn't exercised. 5. Trading strategies using future and options. Basic strategies. Covered call. Buying the underlying stock and selling a call option on it. This is a conservative strategy to earn additional income. Protective put. Buying a put option while holding the underlying asset, used to hedge against potential losses. Straddle. Buying both a call and a put at the same strike price. This strategy is used when expecting high volatility but unsure of the direction. Strangle. Similar to a straddle but with different strike prices. Used when expecting significant price movement. Advanced strategies. Iron condor. Selling both a put and call option at different strike prices and buying additional put and call options at even further strike prices. Butterfly spread. Involves buying and selling calls or puts at 3 different strike prices, used when expecting little movement in the underlying asset. Example of a strategy. Let's say you expect the price of an underlying asset to rise slightly but are unsure about how much. In this case, you could implement a bull call spread, which involves buying a call option at a lower strike price and selling another at a higher strike price. This strategy reduces the cost but limits the profit potential. 6. How to use future and option chain for trading. How to use future chain in trading. Futures contracts are often used to speculate on the price of assets. You can use the futures market to hedge against risk. If you're holding a large position in a stock or commodity, you can use futures to lock in a price and protect against price fluctuations. Leverage. Futures can amplify returns, allowing traders to make significant profits from small price changes. How to use option chain for trading. By analyzing the option chain data, you can spot market trends, gauge volatility, and identify key levels. Some of the most useful methods are open interest analysis. Look for large changes in open interest and volume. Implied volatility analysis. A spike in implied volatility can suggest an upcoming move in the underlying asset. Time decay. Options lose value over time, so understanding the time decay theta is crucial in options strategies. Practical example. Let's say you notice that the open interest on Nifty call options at 18,500 is increasing, and the implied volatility is spiking. You can interpret this as the market anticipating a potential breakout above 18,500. In today's video, we've covered the basics of futures and options, how to interpret option chain data, and several strategies to apply in real-life trading scenarios. Futures and options are powerful tools that, when used correctly, can increase your trading opportunities and profitability. Final thought, remember, trading is a skill that takes time to master, and understanding the option chain is just the beginning. Keep practicing, stay informed, and soon you'll be able to use futures and options to your advantage. If you found this video helpful, please like, share,